film you. So here we are at a critical juncture, talking all day and all week here at the World Economic Forum, really about how we arrived at this place, how it is that we have seen such market deterioration, global economic deterioration. And so here at the World Economic Brainstorming session, we really want to zero in on some of the failures that we have seen. What worked, what more specifically didn't work? What were the policy failures that didn't work? So what we've done is we have divided the room up into 20 tables. Each table has many discussion leaders at the table, and what I'll do in a moment is kick it off to each table individually, and you all should discuss really how we arrived here, and specifically answering 3 questions. We would like you to answer these questions in order because we want to, at the end of a 20 or 30-minute period, come around and pick up those papers and get the answers so that we could put them in the database and then relay it back to you. So you have the questions in front of you. Number 1 is, what are the policy assumptions that created the most damage to the global economy? Number 2 is, which regulatory failures proved to deliver the largest systemic shocks? What were genuine market failures? Bottom line, what market let us down? What policy let us down? So that we can zero in on the mistakes and hopefully not make those mistakes again. So I will kick it off now to all of you discussion leaders, and you should figure out at your tables who will be the facilitator. So as I walk around and listen in, if I may, and eavesdrop on some of your conversations, at the end of this 20 or 30-minute period, you'll have one person stand and tell us really what the table has come up with as an answer to these questions. So please begin your discussions. Start talking about these 3 questions. And then we'll be back to you in about 20 minutes. Thank you very much. Ladies and gentlemen, one more note. The first question is your blue page. It would be helpful if you answered them in order because we'd like to collect them, obviously, in order. In about 10 minutes, we will pick up that blue page. And that, of course, is the question, what are the policy assumptions that created the most damage to the global economy? If you'll start there, we'll pick up the page in about 10 or 15 minutes. How are you? How have you been? Good to see you. Thank you very much. Great. Yeah, that's what I was going to say, too. I mean, I wonder if you could call the idea that we assumed that the industries could regulate themselves. Is that a policy? But I guess it is a laissez-faire policy. Yeah, I agree with you. Yeah. Absolutely. Yeah, I think you're right. It's laissez-faire regulation. Yeah. Yeah, it's an interesting, that's actually what I was just discussing at the other table, because I actually just asked someone, I said, can you assume that a policy is the assumption that there wasn't any regulation? So is a policy the assumption that industries can regulate themselves? And I would say yes, that's a policy. Maybe that's a laissez-faire policy. I don't know. It's not an actual, here's what you do, but it's the industry can take care of itself. But Exactly. Well, that's you're right. It's self-regulatory agencies. Yeah, we actually have agencies that call themselves that. The assumption that lower should be, exactly over that curve. Yeah. Either, I would say. Okay. Sure. Okay. Ladies and gentlemen, you have about 2 minutes to complete the first question, which, as you know, is just up on the screen there. What are the policy assumptions that created the most damage to the global economy? When you are ready, just hold up your blue page. We'll come and pick it up. Got one? Ladies and gentlemen, you can start the second question. We're going to come around, and hopefully your blue page is ready for us. The answer to that question one, what are the policy assumptions that created the most damage to the global economy? If you will move on to the second question and start debating that amongst yourselves. Which regulatory failures proved to deliver the largest systemic shocks? Regulatory failures. Thank you, ladies and gentlemen. Regulatory failure. We will collect the second page in about 10 minutes. We're talking specifically regulatory failures. So you should be talking about question number 2. We'll come around in about 10 minutes for those cards. Thank you, ladies and gentlemen. great point. You're right. Or private equity, same thing. And yet all of the banks are connected globally. And yet the regulatory environment.
Snobby system, that's the fact of life. And they went up with the game. They went up with the case.
Yeah, it's a good point. Ladies and gentlemen, you have 2 minutes to complete that second sheet. That's the yellow sheet. Which regulatory failure proved to deliver the largest systemic shocks? We'll come around and we'll be collecting that yellow sheet in 2 minutes. You finished? I can take it. Thank you. I'm sorry? Well, they call me Bossy Boots. Checking in. Hello. How are you guys doing? You're on to your third question. Wonderful. Thank you. Thank you very much. No worries. That's a good one. No, don't. I'm just listening. I'm just checking in, you guys. Don't mind me. Because that has so many tentacles, so many implications. Yeah, absolutely. Hey, Steve. How you doing?
Good.
Great to
Just
see you.
talked to Don.
I know that we're going to do a tape.
Back at 5:30.
It's okay. I'm sorry. You're going to get squeezed if he's on a 5:15. He's got a lot of press conferences. Yeah.
I mean, this is the best.
I'll talk to you. I'll be back. Ladies and gentlemen, by now we're picking up all the yellow sheets, and please hand in that yellow sheet. Which regulatory failure proved to deliver the largest systemic shock? And if you could start working on the green sheet. And that question is, where did a genuine market failure occur? Where did a genuine market failure occur?
Everybody, both the seller and the buyer, thought that good times are here for life.
Very narrow.
Huh? Very narrow. It has to be wider than that.
Remember that a lot of people were long, other people were short. So some people were assessing this. I think that the point is that people that were taking or making the decision, they will not afford the risk. Maybe the owners were not taking the decision. And the owners at the end of the day paid the bill.
I.e. the responsibility. There was lack of responsibility. Everybody was moving on with impunity. If he was a seller selling high-risk product or commodity, he was getting away with it because he wasn't staying there to own up for it. And the buyer the same thing.
Exactly.
That's a regular.
That's regulatory, yeah. That's a good point, though, yeah.
Can we narrow down to find the consensus?
Rating agencies were being paid by the same company they were paid.
Well, that's a major issue, yeah. Yeah. The judge, the jury, and the executor, all the same person. But that's regulatory, yeah, I agree. The market failure. Well, how do you know how to price risk? I mean, it's the market that's going to decide. Okay. Okay. Yeah. The general market failure. It's a tough question. I'm just saying hi, checking in. Hello. How are you guys doing? Oh, now you're talking about your dinner plans. I'm just kidding. I'm just kidding. So we've got about 5 more minutes for the last question. Where did a genuine market failure occur? We'll come and pick up the green sheets momentarily. 5 minutes. Yeah. So now the next part of this. Tell me how we're doing in the next slide. Then it's over, right? Hello. Yeah. That's great. Yeah, it's fine. A lot of people are saying the same thing. That's good. Thank you very much. That's good. A lot of people say the same thing, which is great. I'm going to explain the lay of the land right now as far as we can hop around the room. That's going to be a 20-minute period where you finish reading the data. We're just going to pop around. Got it. Okay. Yeah, I'm going to ask Alan if that's okay. We can do that. Guys, we're going to need about 15 minutes. So this is really good. I know it, really. Fascinating. This is a great exercise. Ladies and gentlemen, we're going to come around. We have 2 minutes to complete this third question, and that is, of course, where did a genuine market failure occur? Just to give you a little lay of the land, after we collect all of the 3 questions from you, our team is putting all of that data in the computer so that we can relay it back to you. And, you know, it's not scientific. We're trying to pull out the items that were most frequently cited so that you can see. So during that time, that 15 or 20-minute period when they're relaying the data into the computer, we'll pop around the room and find out from you what was the big debate at your table, what was the consensus at your table, things like that. 2 minutes, we'll collect the third sheet. Faiza, are you in the room, Faiza? We're going to start popping around the room, just FYI. You probably want to know that. Gentlemen, we've got about 1 minute, but you should start finishing up that green card. We're going to be collecting that green card. And then what we'd like to do is pop around the room. You know, it's interesting. We've got such informed, global-minded, really deep thinkers in the room that, you know, I'm walking around, I'm hearing so many different things, but at the core, very much similar fundamental mistakes that I think many of us agree on throughout the room. Has everyone handed, does anyone still have a green card that you'd like to hand in? Are these extra? Yellow and green? Those are extra. No, no. So we've got about 20 minutes to pop around the room and talk about what you all have been talking about just over the last half an hour or so. Our team is putting the data in the computer now so that they can relay it back to us. So let's talk about what we've heard. Alan Blinder, there's a woman with the mic next to you. Alan Blinder, please. Can you tell us a little, Alan, about what was most debatable at your table for question one? What are the policy assumptions that created the most damage to the global economy? What'd you come up with?
You want to just do question one?
Yeah.
I want everyone to know that we're table one over here. So,
one is one.
We couldn't decide, and we wound up with two answers to this, which is probably a violation of the law. One is that the belief in what's sometimes called market fundamentalism, that markets are self-correcting, and I guess I should say self-correcting without causing horrible, horrible damage. I guess eventually every market is self-correcting, but self-correcting in a meaningful policy sense that you might even want to let it self-correct. And related to that, the rampant mispricing of risk in the years running up to the crisis, where risk premium shrunk to almost nothing. It's amazing to say that now because risk premium have gone through the roof, but they used to be below the cellar, and that caused a lot of mispricing of assets and too much risk-taking.
Does anybody agree with that? Anybody else come up with those answers as far as the self-regulatory and the mispricing of risk? Yeah. Any other thoughts around that? Yes. Microphone here, thank you. Who would like it?
Hi, we came out precisely with those things. We got on the genuine market failure. We put the misunderstanding, underestimating, and mispricing of financial risk. So it's precisely along the same line. And we thought that it's the lack of regulation of financial market, or the self-regulation, the belief under the self-regulation of financial market.
That was the assumption.
That's
that
the
markets
assumption.
could self-regulate.
The market could self-regulate and solve all the problems, and it's just the sort of the unfettered belief on that, and that every problem will be solved, and that did not happen.
Right here at table 2. Table 2.
I think we also understood that this failure didn't come because people were stupid. It came because disclosure failed. The ability to understand what kind of credit you were taking on. Level 1, level 2, level 3 securities, mark to market, mark to model, mark to myth, No one knew what any of this stuff was worth. And we allowed that disclosure to fail and kept trading securities based on what a rating agency said, but without a real understanding of what the credit quality was.
Now, why wasn't there a real understanding? I mean, I think it's such an obvious and simple question, but any thoughts on that? Table 14, and then we're going to go to Table 11.
I'm not sure this was our fundamental answer, but I think it's interesting we had some discussion about the religiosity behind two things, mathematics and modeling on the one hand, and faith in, that goes back to the faith in the markets being self-regulating.
We came to a very different approach. We looked at how a lot of societies are spendthrifts. So two versions of that at our table were China can do all our saving and you can spend yourself rich. Very wrong assumptions.
Yeah. Who else came up with the assumption that China could do all of the saving?
Hello. We came up with the notion that a lot of your questions weren't very adequate because you're here addressing...
What are the questions to ask?
So let me tell you the problem.
Yes.
My friend Duncan here specializes in complex systems, and the first thing you learn is to stop looking at ad hoc causes. China, subprime, so on. The structure is like you have a sand pile, and you pour grains of sand on a sand pile. You're going to say, oh, it's that grain that caused this to collapse. The structure of the system was fragile. That's the problem.
The whole structure. Tell us more about that.
Yeah, banks were taking a lot of risks in the tails, helped by bogus models that economists developed and promoted. And they were taking a huge amount of risk sponsored by Basel, that value at risk. The risk did not show. People like me who were attacking these models were ridiculed for years. And sure enough, people got what they deserve.
Oh. Table 10 and Table 5. Table 5 and then Jeffrey Rosen at 10.
Okay.
Hello, Mr.
Hi.
Stiglitz, Professor.
Well, I think there at least some of us thought that there was an element of stupidity, and it wasn't just lack of transparency. And it is related in some ways to more fundamental problems. There were problems of incentives to take excessive risk-taking, incentives to underestimate the nature of risk. You have to ask why were there incentives, and that's related to looking at more fundamental problems. That's related to problems of corporate governance. The problems of underestimating correlations, underestimating the probability of a price decline, had been talked about. I had written about this at the very beginning of the securitization, that this was likely going to happen at the end. It's happened over and over again in these kinds of bubbles that go on. And so it is a systemic problem. That's on the private side, and you have to ask the question on the government side, how does it, and that's where the second question, it failed to have the regulations, and that was partly related to what Alan pointed out, the belief in unfettered markets, and that markets would be rational.
You know, the incentives is an important point because it could be one of the reasons that financial services was sort of so dominant over the last 25 years, really. And not only in the S&P 500, but as a place to work, as just because of these incentives, because you thought you were going to make more money versus innovating, engineering. Just a thought. Table 10, Jeffrey Rosen.
Yeah, just to this point of tails and mathematical models and spreads and so forth. First of all, it's inevitable that markets get into these situations. The question is, how bad is the situation when they get into them? Second point is, I think there's been a problem going back over a long period of time of a substitution of mathematics and modeling and mechanics for common sense. And if you look at it, all these people, curious, if you look back
roughly 20 years, to the 80s, mid-80s, late 80s, you can see in the real estate market then substantial losses that occurred in the mortgage securities market, which at that point was effectively a derivatives market, that at the time was based on very sophisticated computer models that gave people the assurance that they could load up on these securities without consequence. And there was a failure of common sense to recognize that perhaps the assumptions going into these models were in some fashion flawed. And if there was a risk of them being flawed, perhaps you should moderate the amount of risk you took on those securities. Not take no risk, but take a lot less risk than the models would suggest that you should do so. And I think it's this substitution of mathematics for common sense that has led to a lot of these problems, including in investment banks and banks that decided that it was very easy for them to turn on the risk-taking taps in such an easily convenient world of those types of mathematical models.
We've got table 7 and then 6.
Yes, we also subscribe to the stupidity theory. We think that the fundamental problem here was one of economic literacy, that the people taking these risks didn't know what they were doing. Well, the people who were regulating them didn't know what they were trying to regulate, and the governments didn't know what was going on. So, fundamentally, it was a stupidity.
You said that similarly, didn't you, Alan? Table 6.
Just a few things. The first is that I think the cross-border effects of securitization were poorly understood. National regulators with cross-border securitization wasn't a straightforward story. The second thing we discussed was the assumptions about inflation targeting, that inflation targeting seemed to deliver a kind of nirvana in terms of economic policy over the last few years, and central banks simply ignore the extreme increases in liquidity over that period of time. And the third point I'd make is that I think many of these models assumed, particularly in the US, that house prices couldn't go down. And we discovered, of course, that they can go down quite a long way.
Why were we led to believe house prices couldn't go down? This is just an amazing... But there was a general consensus that real estate goes up. It's interesting. Table 13.
Thank you. On this table, we felt that for the last decade at least, people have really been swallowing happy pills for far too long. There was a general, and the policy failure was a general over-optimism in both the public and the private sector. So there was a lack of substantive risk management all over the private sector, and in the public sector, particularly in the US, there was a view that if there was ever a problem, the Fed could mop it up, and that view was shared in the Fed itself. So this over-optimism, that spread across all of us, as some people on the table said. We all enjoyed the party, and now we're paying the price.
Right. Boom times, and people weren't thinking that it could end. Philip Jennings at 10.
Thank you. I think one of the policy assumptions that was driving this process was that the trickle-down theory actually worked in practice. And I think you have the revenge of the subprime, because the people at the bottom of the income pile were incapable of settling the debts and the loans that they had entered. And the trickle-down theory was meant to spread the benefits far and wide. The result of this trickle-down theory has been an absence of creative thinking in terms of active labour market policies, and you have societies which are as unequal today as they were in the 1920s. And when we talk about market failure this year here at Davos, we have to talk very seriously about what the social consequences are. 1 hour ago, the International Labour Office announced that as a result of this financial crisis, there will be 50 million people more employed in the months to come. So this trickle-down theory, we have to nail this trickle-down theory, simply didn't deliver. Thank you.
Bob Schiller, table 4.
I'm struck at the great similarity of answers here. Things that I believe were repeated by so many people.
Yes, it's true. Everyone really, at its fundamental core, has the same feelings.
I wonder if there's some selection bias in the kind of people who show up for a session like this. We're all of like minds already. But the thing that strikes me is I've been living in academia for 30 years, and this efficient markets hypothesis has been sacrosanct. I used to have to summon courage to say anything against it, but not a single person here has come to its defense. So this is a paradigm, unless there's a big selection bias, we're going through a paradigm change, and young MBAs are not going to be happy with another set of lectures on market efficiency.
Well, what are the implications of that, Bob?
Well, I am thinking that we have placed our faith in the wrong thing. We're in a period of readjustment. We put too much faith in mathematical models, especially models estimated with short data sets or limited data, and we put too much faith in institutions that seemed historic and invulnerable. And we're going to have to kind of start, someone said, or you said, common sense. I'm not sure what common sense is, but we have to somehow rethink fundamentals that ascribe more to our just general intuitive understanding of how these things work.
You know, it's interesting that we keep forgetting, because we talked about fundamentals when the dot-com era busted. And then we forgot fundamentals again. Table 2.
Yeah, let me build on that. It gives me cold comfort that we are all exhibiting such great insight with 2020 hindsight. And except for maybe Nassim Taleb in the back table, I wonder where we were last year. And how we learn from this in a way where we don't need 2020 hindsight to be so smart.
We were expecting house prices to go up. Yeah, how do you do that? How do we learn from these mistakes that seem to keep happening? Anybody? Table 17?
We focused on a rather different aspect, and that is the lack of moral compass. There's been lots of reliance, as we've seen, on regulation, on mathematical models, and so on. And we thought that that could replace a moral compass, ethics. And perhaps we should devote more time to discussing how we as a society fit together. Less time relying on individualism to get us through, and more on our feeling and concern for the common weal as a constraint on our behavior, and also as a constraint on activities that lead to large market failures. A moral compass may be able to reduce market failures endogenously.
Thank you. Not so different what Philip Jennings was also getting at. Also back to table 2.
Thank you. Sharon Burrow, I want to come back to your question about fundamentals, because it does go to the question somewhat of moral compass, but how does the economy work? You've got to actually ask yourself, how does it work? And one of the things we said here was that capital activity, major capital activity, had got so far out of whack with the real economy that in fact there was a whole bunch of innovation going on that is simply not sustainable. Whether you're leveraging profit off debt and you think it's sustainable, it takes some intelligence to stop and say, well, is that, you know, a possible model for the future? But what the real impact is, as Philip said, is on the real economy. And now we've got this big feedback loop. Financial markets may be stabilised, but they're not recapitalised, they're not lending. Businesses are going out the door. Unemployment, 50 million people more unemployed. Think about that. And then think about why it is that we still hold on, or we let the financial markets hold on to the religion that somehow it's okay to maximise shareholder profit and to drive the wages of working people down, so that the wages profit share is so distorted that you can't keep that economic churn going. So back to fundamentals, let's see some greater equity, let's see some real economy sense, and some regulators that are actually independent, for God's sake, and aren't swept away by the greed mentality of the financial sector. Mm-hmm.
Which is something that you mentioned earlier, actually, as well. Microphone to 18 and then 14.
Sounds like we're a little bit more fundamentalist at this table, though not very much so. Still on this policy assumption error. I think the premise at this table is that capitalist markets do make huge mistakes and make them not the same mistakes over and over again, but always new mistakes from generation to generation. And the policymakers correctly assume that that's the case. They're not stupid. Policymakers realize that markets do make mistakes. So where's the policy assumption that went wrong? We think at this table that the mistake was to believe that markets adjust efficiently to their mistakes. In other words, markets adjust without causing any collateral damage, without causing collateral damage to the banking system, for example. And what happened, of course, in this recent downturn and this recent collapse of asset prices, which is not the first time in the history of capitalism that asset prices collapsed, was that the banks had put themselves in such a vulnerable position that they went underwater as a result of the decline in mortgage prices and various other asset prices.
14 and then to 12. And right here at 16 before, 14 and then 16.
At our table, we objected to the second and third question, and a lot of what has come up is consistent, I think, with our objections. The second question said, what was the major regulatory failure? And our discussion led us to the point that there's a sense in which regulatory failure was endogenous to or a function of the faith in the markets and the inability of and the pressure from interest groups in the market system on the regulators. So I think that's something that has been reflected indirectly in some things that have been said. And the third question was, what was the key market failure? And there we had some discussion of the question between the economists, who have a specific notion of market failure, and the non-economists, who talked a lot about the problems in the way the markets worked. But I think our fundamental bottom line is that the failure was less in the markets, which responded in non-competitive arrangements sometimes to prices, but the failure was on the government side or on the side of the state. So I think it goes back to the issue of the line between the state and the market in much of what's being discussed here is being redrawn.
It's interesting. So are you saying that there was not a real market failure, and you're not really believing that there was a failure on the part of regulators, except when it relates to lobbyists or listening to special interest groups?
No, not at all. We're saying that neither of these is that the regulatory failure question doesn't go to the fundamental root of the problem. We talked a lot about the international, the problem of moderating cross-border flows, the global imbalance leading to a liquidity glut, which created pressures because of the bubble on the regulators indirectly. That goes back to the faith in the market to be self-regulating.
Thank you. Right here.
So picking up on this last point, our group felt that one of the fundamental failures was around transparency, which led to the inability to price assets correctly. And then when you looked across it, you had at the core this confidence crisis where the interbank lending absolutely seized up. And many of the people around the table saw the epicenter actually around the Lehman failure, whereby when the Fed did not come in with Lehman, the onlookers started this huge confidence crisis that started at that epicenter because things would be all right. There was the optimism and confidence. But the lack of transparency, not having assets priced correctly, having this earthquake around confidence that rippled across the planet, then led into the seizing up of interbank lending, and it matriculated through. So the result of, poor assumptions in policy making and poor policy.
16, table 16.
Well, we agreed with a lot of what people said here about self-regulation, about the whole issue of systemic risk, but I also think that we were not as willing to let governments off the hook as a lot of people seem to be talking about fundamental problems or that's a problem of the system. But I think people here felt that there were specific errors on the part of policymakers, that they allowed cheap money to go on too long, particularly in the United States, Britain, and some of the other countries where housing prices, that they ignored asset bubbles and thought everything was fine because inflation seemed to be under control, and that they allowed deficits to persist for far too long. So I think people here wanted to be very specific. There were specific government failures as well as a bigger, larger failure of the system.
Yes, sir, at 17.
Thank you. It's intriguing no one's to blame here. In most fields of industrial endeavor, if you make and sell toxic products, either knowingly or unknowingly, the consequences are serious for those that do it. You go to jail. Policymakers make it abundantly clear, so we behave properly. What I wonder is, did the policymakers make it clear to the investment community that if they make and sell toxic products, which will do great harm, that the consequences would be severe?
Can you apply that in every market? Can you apply that in every market?
Yes. Food and Drug Administration, health and safety, our businesses are controlled and constrained in every way. And we have to
the
act
assets that you're referring to dropped in value as the market deteriorated. So I'm wondering if you can blame those sales of those assets during a market that was accepting them.
CDOs?
I'm sorry?
CDOs?
Yes.
Oh, they just dropped because it wasn't anybody's fault? You mean people didn't know that these... Right now, we're still trying to argue what these things were worth, where they are, who owns them, how they were manufactured. How does that work? Trillions of dollars have been lost because of some of these products. Not all of them, but some of them. So my point is, policymakers need to make it clear that there are consequences, serious consequences, for inappropriate behavior.
Thank you for that point. Alan Blinder, I'd like to get your thoughts on that.
Well, I guess I agree. I wouldn't have quite put it that way, but certainly with the last sentence, I think most of us would agree. I wanted to circle back to the market failures, since I interpreted when I started, you only wanted me to address on behalf of our table the first question. But on the second, there was a lot of discussion around this table around three things. Economists wouldn't call these market failures, but normal people will call them market failures, and that's better for this purpose. One is excessive complexity in these instruments, which was just alluded to. If nobody knows what they're buying and selling, you're looking for trouble. And this was fee-driven, clearly. Secondly, risk management practices in the companies, you could also say in some of the government agencies, but I want to stick to the companies, that can only be called atrocious. And thirdly, go-for-broke incentives that led traders, and to some extent the executives to whom the traders were reporting, to, guess what, go for broke, which they achieved.
You know, ladies and gentlemen, the votes are in. We want to try the voting mechanism out, and we want to bring you the results of what we came up with. Now, it's not scientific. We put together the most frequently named reasons and solutions. So if we could put those slides up now. Okay. We're going to go to question one. This is the console that you have. We're asking you to put into your voting console what part of the world you're from. This is really just a test vote so that we can get a sense of who we're talking to. So just press 1 if it's Europe, 2 Middle East, 3 Latin America, 4 Asia, 5 Africa, and 6 North America. What part of the world are you from? This will just take... Now we will get... Okay, just to give you a sense of who we're talking to in the audience, 40% from Europe, 5.4% Middle East, 6.7% Latin America, 14.8% Asia, 5.4% Africa, and 27.5% North America. We'll go to the results of the first question, Lee. And as we know, these are the 7 answers that were most frequently cited as which of those assumptions is most widely held today as far as what are the policy assumptions that created the most damage to the global economy. So very much what we heard just a moment ago in our discussion, self-regulation of markets, the assumption that markets can self-regulate, cheap money financing, assumption of economic literacy, which obviously also came up quite a bit. Good times last forever. We thought that real estate prices would keep going up. Putting regulation over ethics, very much the moral compass note. High leverage, the assumption that high leverage is good and that China can do our saving. It is interesting that throughout the world, these 7 ideas keep coming up in terms of the assumptions. Now, you can use your voting console to actually vote which assumption is most widely held today. So if you will do that, and on your voting consoles at your table, just press which assumption you believe to be most widely held today. We'd like to zero in on this after the crisis. And, well, debatable if we're still in it, but after what we've seen so far, which of these assumptions is most widely held today? And we will further scrutinize this data. Self-regulation of markets, 50.8% still. So there is still a belief and an assumption widely held today that the markets can self-regulate. No. Is that not right? Can we do you want to do a revote? Wait a minute. What? Right, I realize that. Right. Yeah. What the organizers would like to know is which of these beliefs is still most commonly held today? Which is most commonly held today? I mean, clearly this is what we all thought, so it's the same answer, Lee. It's still being held. They've answered the question. It is still being held. That's right? Right. Yeah. Everyone is answering what did the most damage, question 1. That is the bottom line. This is what everyone is talking about. Right. I understand. And what the organizers would like is, it's a subtlety, but which assumption is still being held today? It's the same. You're not the same. Okay. Let's do question 2. Which regulatory failures proved to deliver the largest systemic shocks? Which regulatory failures proved to deliver the largest systemic shocks? What did you say? Now, this question, another subtlety. Which should the G20 look at? This is your vote here in the room. Which should the G20 look at as far as the most important out of the 6 that we have come up with, that you've submitted? Which regulatory failure should be the top priority for the G20? Would you vote right now? Okay. We're not asking you to vote again on the most popular in terms of the regulatory failure. We're asking you a follow-up for the G20. Lack of international regulatory framework is number 1. And this should be the top priority for the G20, followed by non-regulation of leverage, which is an interesting result. Non-regulation of leverage. Inability to assess risks properly, followed by securitization not adequately regulated, and misplaced confidence in ratings agencies. That came up quite a bit, actually. Now, for the third question, we will put up your answers, but we will ask you to vote on the follow-up again. What were genuine market failures? We will put those up. Misquotation of risk valuation, misalignment of incentives and performance, governance failure, improper assessment and pricing of tail risk, failure of interbank lending, excessively complex financial instruments, and disregarding risk. So the follow-up question we'd like you to vote on, if you will, please, is which of these market failure risks the greatest public backlash? Okay, which market failure risks the greatest public backlash? Misalignment of incentives and performance, almost 42%. Governance failure at 20%. Misquotation of risk valuation and pricing at 15%. Disregarding risk. Now again, this is just a sample. It's not scientific. And you know, one of the issues, this backlash from the public, what do you think it is going to take to have people feel satisfied that people are accountable for the misdeeds and for the upsets that we've seen? Is it people going to jail? Is it fines? What do you believe will make people feel, the public, outrage that those who made the mistakes have been accountable? Anyone? Alan Blinder? I'm sorry? Public apologies.
Apologies from both public and private actors.
Another.
It's very important to be able to show that this is not going to be repeated. And the systems and governance system should be reformed in a way that this cannot be repeated.
Show of hands, who thinks this will be repeated? Why is that?
Can I tell you, Maria? Can
Yes,
I tell
please.
you what's happening? Okay. This happened in the past.
Right.
It keeps
Which
repeating
is why
itself.
I asked the question.
It keeps repeating itself. We keep bailing them out. The only way this will not be repeated, is if you had punishment. The only place in which you had punishment is here, Switzerland. They went back and clawed back the bonuses. Until we do that, we'll always live under moral hazard from banks.
So the leaders who were in charge, taking on that risk, selling those complex products, should give money back.
Yes. There's a gentleman who was a government official, Bob Rubin. I think he pocketed $115 million from Citibank. Now, I don't know how many American taxpayers there are here. We are paying for that. That should not happen again, but it had happened. It has happened several times in history. Unless you have punishment, you will never be immune from these abuses.
So the bonuses for the last how many years should...
I don't care, whatever, something. In Switzerland, they settled it. They did it very properly, and they did it very responsibly. This is the only country here, Switzerland, that acted responsibly.
Show of hands, who wants the money back? Where does that money go? The banks and then shareholders? Where does the money go?
Maybe a lot of people here have, maybe the ones to have to return the money, all right?
You're a minority on that, by the way, with the show of hands. Yes.
Maria, as an entrepreneur, I feel that the only solution really is disgorgement. You build companies, you work so hard, and you see people feeding on the trough, and unless there's disgorgement, there will be no lesson learned.
Yes, sir. Table 4.
It's interesting how little discussion has been of developing countries this afternoon. But the impact of this recession is being felt really sharply. Lower remittances, tourist bookings are down, price and volume of exports of goods and services are down, portfolio flows are being repatriated. We've seen what globalization can do to lift people out of poverty. There are many positive lessons. So surely the best thing to come out of this crisis is going to be a reaffirmation of what we believe in as a world community, to look after each other, to build a world which meets the Millennium Development Goals. And if we have money to spare that we're going to take back from the bankers, that's where it should go. Let's put it where people need it most.
Thank you. Yes, sir. Right here at table 3. And then we'll come back to you. My apologies.
I think Jean-Pierre Lehman, no connection to the bank.
Thank you. Thank you for pointing that out.
Very fascinating discussion. Like a lot of people, I think I'm struck by the fact that we all agree, very, very much so. I worry a little bit about what happens next. I mean, for example, I have no problem with corporations being concerned about enhancing shareholder value. I have no problems with them creating wealth. What I have problems with is when they're not doing that, when they're destroying wealth. This is what we're actually seeing right now. So, but having said that, I think we can have a pretty good consensus on what happened. What would be very interesting is, where do we go from here? You know, we seem to be raising a lot of questions about the market system, about the market efficiency, etc. What are the paths that are going to be, what can we believe in that might sort of lead us over for the next 2 or 3 years?
Well, it sounds like we're going in the direction of more oversight, more government. Anybody disagree with that? And more accountability.
I think what's going to be necessary is not just a recognition that there's been perhaps too much faith in markets, but some specificity about that. It's very easy to say there's been too much faith in markets. But I think if you just say that, then you may wind up with overreactions, and you may wind up with saying that, well, you know, any time somebody sells a product and it takes a loss, they're responsible for that. Clearly, that would be going too far. I think we need to think through analytically what specific steps, where specifically the regulatory failures were, and what specific steps are needed. Alan pointed to a few of those earlier, but one of the specifics, and I'm not saying it's limited to this, I think we need to look very broadly, but one of the specifics is there's reliance on private regulatory agencies, or private agencies to assess the risk in debt, and those agencies had conflicts. They had an interest.
Right.
And addressing that is one specific thing that I think has to be on the table.
Your colleague at your table. and then we'll go to 18.
I'm pretty sure that we're not going to have any clawbacks of compensation or disgorgement in reality. But I think at least the institutions which have been bailed out, can we have some kind of cap on the compensation of the people who are still from the old management? Thanks.
Yes, sir.
Yeah, thanks. If I could just say a word about Davos as well, John Evans. Phil Jennings pointed out unemployment is going to probably increase by 50 million this year as a result of this crisis. And an awful lot of those people unemployed will actually look at everybody who's collectively represented in Davos and say they're responsible for large part for the system going wrong and not actually paying now for what's happened. If I could make one suggestion from conclusions in Davos as well, that really an effort to think how do you open up the redesign of the system, the financial system, away from simply just people who may be already bankers or technical experts, to get some genuine public stakeholder involvement and openness and transparency about what the new rules are going to be and how people engage with that system.
Mm-hmm. Robert Schiller.
Continuing on that theme, I think that we have to, the biggest outcome, good outcome that would come from this kind of crisis is that we would make a better public commitment toward what I call the democratization of finance. Finance is a powerful technology that brings prosperity, but we have to make it work more for the people. We have to spread it out more. This crisis, one particular example of the problems this crisis has caused is a huge increase in mortgage foreclosures. And we have lots of personal bankruptcies, and this represents a failure of our institutions. Risk management institutions is supposed to help the people. And the fact that some people are getting very rich off of it, it means that the institutions haven't been done right. So we should be thinking forward-looking now. How do we make financial institutions really do risk management, really work for everyone?
It's a great point, and Philip did make that point, similar point earlier as well. Yes, thank you. We are going to have to wrap it up because we've got to turn. We have one more comment before we wrap this up. Yes, sir. Table 2.
It would look to me that one of the issues is the concept of segregation of responsibilities and then the inversion of skills that we see in most institutions. We tend to associate supervision with seniority as opposed to skills, and typically the people who are employed to develop modern financial products are people coming out of universities with PhDs, what we would call rocket scientists literally. And people who run the institutions and supervise them are people with gray hairs like ourselves, and most of them out of it in terms of really understanding what the products and the risks associated with them are. And it appears to me that we need to get a bit smarter and use a lateral supervision system or segregation of responsibilities. Use rocket scientists to develop the products, and use other rocket scientists, not necessarily senior to them, to supervise and understand what is going on.
Thank you so much. Thank you so much, everybody, for your participation. We are going to turn the room around quickly for the next session. We appreciate your participation and being with us today. Enjoy.